The currency right now 80.5 to the US dollar. We saw it breaching that key 80 level. Some are now speculating that the shilling could strengthen even further because of the heightened optimism after S&P changed Kenya's credit rating to B+ from B.
Well, thank you very much for having me here. Well, I think I echo your sentiment on that regard, because looking at what, the revision of the rating by the S&P, it gives Kenya the limelight, it deserves. So going forward, what we do expect in the market is that you are likely to see the Kenyan shilling appreciate to the dollar, and I think the CBK would again come in and intervene at a certain level.
Well, Henry, it's interesting you mentioned the word intervene. Some don't see it as intervention. Others say it's just literally the central bank embarking on its strategy to increase reserves. Do you think it is a matter of intervention, that if the shilling does hit below that key 80 level, because that's when the central bank perhaps gets a little nervous, how do you see that playing out?
Well, there's a huge factor to consider here. Going by what the Americans said to do on the QE, the quantitative easing tool plan, that has brought in some kind of effect on the shilling, because you do remember 2 weeks ago when I was here still commenting on the same issue. We saw the shilling go to 79, and when central bank came to the market, it went back to around the 80 shilling level. So in as much as they are trying to increase the import cover, we only have a window of 1 month to improve that cover. So once that is filled, then I think it will be purely intervention, and I guess that will come in towards the end of this year.
Do you think that the Central Bank of Kenya is going to intervene once they do have the right cover, as you then alluded to, when it comes to reserves? Do you think we'll see more intervention even after the reserves are then garnered?
Well, not necessarily, but what I think central bank would be doing is by following the mandate of maintaining a stable monetary policy, then I think when need be, they would be obligated. They would find it within their policy to come into the market.
Henry, where do you peg the shilling going forward and into 2011?
Well, into 2011, looking at what is happening in the world and the rebalancing, of the world economies, I do peg it around the 78, 79 level for some through the first quarter, not unless again something adverse happens in the horizon, which I don't foresee for the moment. But I give it around that level of 78, 79 level, 80 level.
Looking at the 5-year bond auction, that's set to close tomorrow. We know results are going to be released later on this week. What is the anticipated uptake of this 5-year bond? Well,
again, being a medium-term bond, I think most investors will be keen to come into the market. Again, taking into consideration that there is a bond that is being retired that has 3 days to go, we are expecting an additional 6 billion or so into the market. Well, appetite certainly is going to be there. The question will be at what level will the coupon come out at, and at what yields will the bond going to, with the results going to come out at? Because looking at the yield curve right now, most people, the market is a bit quiet because most people don't know where the results are going to come out at. And if they come out at, I'll say, the 6.2% yield level, then I think the market will have factored in all that and trading will be as normal. But if it comes anything higher, then for sure we are going to see some revaluation in some of the portfolios.
Well, some say that it might come in higher because we also look at what's been happening on the secondary market, and that's perhaps pointing to higher levels. Yes. What is your view on that? Do you think it could perhaps surprise investors?
Sure, for sure, because just taking a case in point, if you look at the 10-year bond that was issued 3 weeks ago, we saw where investors were, and we saw where the analysts' view was, but it came a whole 100 basis points higher than where expectations were. So to me, it wouldn't be a surprise if it came anything higher than what even people are expecting. But for the aggressive ones, we've had people saying that they are going into at the 7.2%. 5% level, which to me is a bit aggressive, but again, it's a market, and I believe that we are in also for a modest surprise, if not a big surprise.
You know, when we see what's been happening on the equity front, it seems some people are taking money off the table. It's pretty much the same story every year, people booking profits for the holiday season. What can we expect in the week ahead from a fixed income perspective?
Well, in the week ahead, we see most banks are closing off their positions for the year. I mean, we are going to December. It's a festive period. Most of the financial institutions would want to be liquid enough to cater for most of these. For most of these needs, and we're likely to see more of a sell side market rather than a buy side market. And again, the outcome of the market again will be determined by the results of the 5-year. If it comes at levels which we didn't expect, and it pushes higher the yield curve, then we would expect that people will be trying again to reevaluate their portfolios in line with the current with the current results of the market, which again might spur or again deter activity in the market.